3 or 4 rises. Get away. I'm just getting like, do you see that? Oh gosh, here we go. The dog's coming back again. Oh God. All right, welcome ladies and gents. And I hope you're enjoying the new shorter video formats at the moment. Today, the wind is absolutely howling. You would not believe. So I've got this little wind stopper here. So hopefully this is going to work and this audio isn't going to be ruined by wind. So today we're going to talk about why asset prices could crash very, very badly this year in 2022. Not necessarily in the next couple of months. I'm not talking here, but mid to late year. And I'll go over all of the reasons why I think that could happen in this video. So we're going to talk about 3 main components today then. One is quantitative easing, the other one is quantitative tightening, and then the third one is interest rate. Now, if you don't know what those first 2 terms mean, I'll explain briefly anyway, so don't worry. So let's start with quantitative easing then, also known as QE. So what does this mean for you? What does it mean for your house value and your stock portfolio or whatever other assets you own? Well, quite simply, when the central bank of your country starts doing quantitative easing, what this does is, and again, a lot of people argue this, but what it does is it helps to push up asset prices. It creates a lot of excess liquidity, which makes its way into the market. So that's the first thing that QE does. And what quantitative easing is actually the central bank creating new currency. So the reason that the markets are spooked at the moment, and you're seeing a lot of volatility, is because the Fed, let's talk about the Fed because it's the easiest central bank to talk about. They indicated that they wouldn't start or wouldn't end quantitative easing until December time, so late 2022. That's what they indicated. They didn't sort of say it outright, but that was their indication. And of course, due to this indication, the markets went crazy, stocks went crazy, and everyone expected it to just keep going. But of course, in November of 2021, so just 3-4 months back now, the Fed actually did a major U-turn and said they were going to start doing tapering, which is part of quantitative easing. Quantitative easing is obviously creating more currency, and then tapering is to start reducing the amount of new currency they're creating. So it's different to tightening. So that's what they indicated, tapering, and that would be at $15 billion per month. Well, guess what? Just 1 month later, in December of 2021, they did again a U-turn and said, we're not going to taper by 15 billion a month. We're actually going to taper by 30 billion a month beginning in January, so last month now. So by the middle of this year, this is going to pretty much be over in terms of quantitative easing and new currency creation. Now, this is not good for the stock markets or asset prices at all, because if you don't have all this new liquidity and all this new currency pumping into the markets, then you have to rely on other metrics for stock prices and other asset values to go up. And I just don't see those other metrics at play right now. I don't see super strong companies like we're being told about. I don't see it personally. I think they are, let's just say, lying. I mean, they're putting out all this spin that, wow, the markets are so strong and all this sort of stuff. I don't see it. I don't see companies strong. I don't see company earnings strong either. We'll talk about that. But of course, the other big one here is QT. That's quantitative tightening. Now, this is where they actually suck money or currency or liquidity. Think of it as liquidity. This is where they suck liquidity out of the markets. Now, if you suck liquidity out of the markets, what do you think that's going to do to asset prices? Then, of course, not just with quantitative tightening, so withdrawing currency, but you also have interest rate rises. And of course, a lot of people love bashing me on this, but again, this was accurate forecasting. They have started to do interest rate rises in the Bank of England. And I think the Federal Reserve is going to do anywhere from a 25 to 50 basis points rise in March time. Now, I'm going to gamble here and I'm going to say 50 basis points. And that's purely based on the CPI numbers that we had yesterday. Very, very high still. It was funny. A lot of people were asking my opinion on this because they're saying, I just saw this commentator on Yahoo Finance or CNBC saying that the CPI numbers are going to be much, much lower, around the 4.5% mark. I don't know where these people are getting these sort of numbers from, but it was pretty obvious to me we weren't going to see 4.5% inflation. So what we have then, whoa, this wind is crazy, gosh. So what we have then is QE, so stopping creating new currency, QT, tightening, so withdrawing currency, and interest rate rises all at the same time. Now, I wouldn't be surprised if we saw 4 to 6 rises in the United States this year. I've already given you my forecast for the Bank of England, and that's 1.25% by the end of the year. I don't have a forecast for you right now on the Federal Reserve because I need to wait a few more weeks. I need a little bit more data, but I do think we're going to see 4 to 6 rises. Now, if the first rise is 0.5%, so 0.5%, or also known as 50 basis points, then obviously we're not going to see 6 or 7 rises this year. It will be more like 3 or 4 rises. Get away! I'm just getting, like, do you see that? Gosh! Okay, relax. Jeez, this dog. Okay, well, I completely lost my trail of thought. I have no idea what I was talking about now after getting jumped by that dog there. Goodness me, what? Anyway, let's carry on. One other thing that Jerome Powell has done a U-turn on from the last FOMC meeting was he's finally agreed with what I was saying in my videos last year. You can watch those videos like the semiconductor one. That's a very good video because I did a lot of in-depth research into the semiconductor shortage and what was going on there. Now, he's now saying that yes, these sort of factories and the semiconductor problem isn't going to get resolved for a long time yet. Oh gosh, here we go. The dog's coming back again. Oh God! This dog will not leave me alone. I don't know what is going on with this dog. So he's now admitted then that these supply chain issues will continue until at least 2023, especially with the semiconductors. Now, this is quite a crucial component because what is causing a lot of the inflation and a lot of the supply chain bottlenecks, especially in the auto industry, and a lot of the consumer electronics and products, is the semiconductor chip shortage. This is one of the biggest problems. So one lie that I keep hearing all the time from Jerome Powell as well as a lot of economists is that the economy is super strong this year. That is just not the case. The economy is not super strong. It might look strong, but it's not. Now, what are they looking at? They're looking at the job numbers, and they think that the job numbers are really strong. Just because you have a strong labor market, that doesn't mean you have a strong economy. Although that's what a lot of economists believe. But yes, okay, I admit that the stock market has been doing well these last 2 years. And that's against some of my expectations. I didn't think the stock market would do as well as it has done. But again, look at the amount of QE that has been produced. Look at a lot of the problems that have been produced, which has benefited the stock market. I mean, we only have to look at some of the problems that we're seeing right now with volatility. Look at the NASDAQ. What is it? 50% drop in a lot of the stocks throughout the NASDAQ at the moment. We've seen a lot of volatility from Facebook to Spotify to Amazon. And this is just the beginning. It's going to get a lot worse than this. Because once you see the corporate earnings start to miss expectations, you're going to see a lot more sell-offs like you did with Facebook recently. Now, of course, yes, when someone sells one stock, they reallocate a lot of that capital into other stocks that might be safer. That's not a question here. But the real issue that I see, man, I cannot get away from this dog. He just will not. Get away! Jeez, that dog. What the heck is wrong with that dog? Just menacing everyone. I love dogs, by the way, don't get me wrong. I love dogs, just not when I'm trying to record a video. So overall then, let me just summarize here. QE, QT, interest rate rises, I think is going to drain liquidity from the markets, and I expect asset prices to go down. Again, I covered this on the Sunday stream, but you're going to see the riskiest assets go down first, and then the safest assets go down later on. What are some of the safest assets? Houses. You've heard me talk a lot about the housing market crash and why it will occur, because irrespective of everything else and dates and timelines, as I've always said, there's always one metric that always brings the housing prices down, and that is the affordability metric. Everyone always gets capped out by affordability at some point, and then the market has to correct to come back in line with that historical affordability level. And for those of you who are thinking, yes, Neil, you know, that is probably what's going to happen, but the central bank could do QE again, they could stop the QT, they could lower interest rates. Yes, they could do these things, but I don't think they will this time around. Why? Because they've already tried it. Look at the last 2 years. It's been a failed experiment. Well, it's been a successful experiment in some regards to stop a major depression, which is what it would have been. But long term, we're still going to see another recession. We didn't really, I mean, they called March 2020 a recession. It wasn't really much of a recession. A lot of people call it a bear market. Again, it wasn't a bear market. It was just a drop and then a correction again. But overall, I blame the central banks for all the problems that we're experiencing right now. I think that they have caused everything that's going on because they broke their promise to the people. They should have looked after the people, put the people first, but instead they put the government first. They helped their government buddies by creating all this currency for the government, and this is the result that we've now got. They've really failed the people, in my opinion. So that's it for today. I know this was a strange video with this walk and the dog and whatever else going on here, but thanks for watching, and I'll see you again very soon. Take care. God bless.